Welcome back. Low to negative rates, an escalating trade war between the world's two largest economies, a global slowdown in growth, and now an impeachment battle in Washington. And yet we're rallying today with the all-time highs in sight. Here to explain why and where to put your money, Mariann Montagne is portfolio manager at Gradient Investments, and Ryan Kelley is portfolio manager at Hennessy Funds. Great to have you both here. Mariann, I'll just start with you. Does this market action sort of make sense to you? Why do we keep climbing this wall of worry?
Well, I think what we've found is, at least politically, the Republicans don't have the votes that they need, and the smoking gun that was revealed this morning doesn't have much smoke to it. So I think it's back to fundamentals, and that's earnings growth, valuations, and where are interest rates right now, and where can people make the most income or growth that they need for their own personal needs. And so it's back to the basics again. You know,
it's interesting because Rich Bernstein was on Power Lunch yesterday talking about how he is sticking with defensive plays, Mariann, because he sees a slowing. You talk about the fundamentals. He says they're slowing. There are people concerned about earnings growth into next year. Do you not share those concerns?
Actually, one of the areas that I like the best is the healthcare sector, which is defensive. It hasn't really done well so far this year because of political concerns. But as your previous speaker was talking about, when you don't have changes to the overall system, when the Democrats and Republicans can't come to any agreement, where's the threat to the healthcare pricing? So that's one where we see about 5% growth in earnings this year, 10% next year. And, that's pretty healthy growth. And it's selling at a 15% discount to the overall S&P multiple. So that's a pretty good value in our mind.
Ryan, let me bring you in here and also mention some of the latest headlines we're getting. The president himself casting some doubt on passage of the USMCA, the Mexico-Canada trade agreement, saying to the point that Senator Gregg made a moment ago that Speaker Pelosi, quote, may not have any time to sign it. Again, does that play in to you bearishly, or tell us where you think the right way is to be in this market?
Well, sure. I mean, I think that the market has certainly shown a lot of resilience this year. There's been a lot of headlines, a lot of negative stuff going on, and this is just another example of it, unfortunately. We keep waiting for these trade deals to get done. We keep waiting for the China-U.S. relations to get better. And we sort of needed the Fed to come in and step in 2 times to lower rates to keep us going. And I think that's probably where we're going to be for quite some time.
Do you have further rate cuts baked in? And do you share Mariann's enthusiasm for the healthcare sector? Where would you position people?
Well, actually, I think that there's going to be the sector that's done the best in the last year, and I'm not talking since the beginning of this year, but over the year period. The two have been utilities and real estate. I actually think that utilities still look very attractive here. And one of the big things going on there, which is different, is they're stable, they're less volatile, they have nice dividend yields, but they're actually, believe it or not, in a period of earnings per share growth, which is double of what they normally are.
Yeah, that kind of growth looks pretty good in this environment, I guess. Mariann, just coming back to the healthcare space for a moment, some are saying everything that's played out this week with the impeachment inquiry reduces the chances that Biden is the Democrats' candidate in 2020, increases the odds of an Elizabeth Warren, who has a Medicare for All plan that would not be great for the healthcare space that you mentioned. You worried about that at all?
I'm not at this point in time. I mean, we still have multiple candidates. Someone else could come in. Things can change. So I'm not going to get concerned about that. But just piggybacking on the idea of the utilities being a good choice because of their high yields, I manage a ETF portfolio that provides a 6% yield. And we're doing that by using multiple asset classes. So we're using high-yield stocks, high-yield bonds, preferreds, business development companies, et cetera. And by doing so, you reduce the volatility of being in any one of those particular sectors or subsectors. And so you end up with something that's got about half the volatility of the market, yielding 6%.
But that's impressive
6% is not a bad return.
6% is harder than ever to get. Is it pushing you into riskier investments because you can't get them in the boring old safe ones anymore?
Well, again, your boring old safe ones are going to be like your 10-year treasuries, and they've dropped by about 1.2 percentage points since the start of the year. So it does push people into stretching for some yield. But again, when you diversify and you layer on the fact that they're ETFs, not individual securities, you get really good diversification and risk reduction that way.
All right.